Welcome back to our market analysis channel. Today, January 22nd, 2026, we will analyze in detail the movements of gold prices and provide useful advice, especially based on signals from the U.S. Federal Reserve, also known as the Fed, and the actual market situation. Right now, the most notable point is that global gold prices have continued to set a new all-time high, surpassing the level of $4,800 per ounce. This figure is truly astonishing and reflects a very strong increase in safe haven demand worldwide. Investors are flocking to gold as a way to protect their assets against economic and geopolitical uncertainties. With this trend, our first piece of advice is that you should consider maintaining long positions to get ahead of potentially large upcoming market movements. The fact that gold prices are at record highs shows that upward momentum remains very strong. However, the market never moves in a straight line. We have also witnessed a slight pullback in gold prices right after political tensions in some regions showed signs of easing. Specifically, this occurred following somewhat more conciliatory statements from the United States. This demonstrates that gold prices are extremely sensitive to political news. Therefore, the second piece of advice is to closely monitor breaking news and update information continuously on an hourly basis. Capturing information quickly will help you manage risk effectively and avoid being caught off guard by sudden market reversals. Of course, when it comes to gold, we cannot fail to mention the Fed. Every move by the U.S. Federal Reserve is always the focus of investors' attention. Currently, most of the market expects that the Fed will not raise interest rates in the short term. An accommodative monetary policy or maintaining interest rates usually provides strong support for gold, because it reduces the opportunity cost of holding a non-yielding asset like gold. Therefore, if you believe that the Fed will keep interest rates unchanged in upcoming meetings, gold is very likely to continue maintaining a mild upward trend. This is a fairly optimistic scenario for those who are holding gold. Another important factor driving gold prices is the volatility of the U.S. stock market. When stock indices fluctuate sharply, investors tend to withdraw capital from risky assets and seek safer havens. And gold is the top choice. We are seeing a strong increase in safe haven capital flowing into gold. The advice here is that if you notice continued instability in the stock market, gold may attract even more capital. This is a classic inverse relationship. When stocks fall, gold often rises. Looking back at last year, we can see that the Fed's interest rate cuts caused the US dollar to weaken significantly. A weaker dollar makes gold, which is priced in dollars, cheaper for investors holding other currencies. This stimulates global demand for gold and pushes prices higher. This is a very positive signal for gold. Therefore, our long-term advice is that when you see the dollar trending downward, consider holding gold as a strategic investment. This trend may continue in the near future. In addition, it is impossible not to mention the competition and impact of gold exchange-traded funds, or gold ETFs. Capital inflows into these ETF funds are increasing very strongly, creating significant buying pressure in the market and driving gold prices higher than initially expected. These funds buy physical gold to back their fund certificates, thereby directly affecting supply and demand. However, investors should note that when ETF inflows increase, holding costs are also a factor that needs to be considered. Carefully review the associated fees before deciding to invest in these funds. Finally, let us look further into the future. Some major global investment banks have begun to raise their gold price forecasts for the end of 2026. This shows the optimism of experts regarding the growth potential of this precious metal. Based on these analyses, we offer our final piece of advice. Consider setting a long-term price target for gold, possibly above the level of $5,000 per ounce. Of course, this is an ambitious target, but with the current supporting factors and future potential, this figure is entirely achievable. In summary, the gold market is in a very dynamic phase with many influencing factors. Always keep a cool head, continuously update information, and make wise investment decisions based on thorough analysis. First, let us talk about the most important factor currently driving gold prices, the Federal Reserve's interest rate policy. At present, the market is forecasting that the Fed may not raise interest rates at its upcoming meeting. If this becomes reality, it would be extremely positive news for gold. Why is that? When interest rates do not increase, the opportunity cost of holding gold, a non-yielding asset, decreases. This makes gold more attractive in the eyes of investors. Therefore, my first and most important piece of advice is to closely monitor all information related to the Fed's interest rate decisions, and if possible, update it in real time. A surprise decision from the Fed can create a major shock to gold prices, and you need to be ready to seize the opportunity. Next, we need to look at the inflation picture in the United States. Recently, gold has often been viewed as a safe haven asset when inflation rises. However, if upcoming economic data show that inflation is stabilizing more than expected, or even declining, this safe haven motivation could weaken. Specifically, if the Consumer Price Index (CPI) is released and shows a sharp decline, this could be a signal that inflationary pressures are easing. In this case, investors holding gold should consider taking partial profits. Do not be overly greedy. Preserving gains is just as important as seeking new profits. Another notable point is the market's expectations regarding the Fed's monetary policy. After a series of less than optimistic economic data releases, the market is gradually believing that the Fed will not rush to tighten monetary policy aggressively. This very expectation has helped gold stage an impressive rebound. This teaches us an important lesson. Sometimes, the market's reaction to expectations is more important than the actual news itself. Therefore, the advice here is to always keep your focus on the Fed's working schedule, especially interest rate decisions. This is precisely the compass guiding the trend of gold in the near future. Besides inflation and interest rates, the labor market is also a factor that the Fed pays special attention to. Strong employment data usually indicate a healthy economy, giving the Fed more room to raise interest rates aggressively to curb inflation. Conversely, a weak jobs report may cause the Fed to hesitate. The Fed can react almost immediately to these data releases. Therefore, a golden rule for traders is absolutely avoid placing large trades right before major employment reports are released. The market at this time is extremely volatile and unpredictable, and the risk is very high. Be patient and wait until the market has fully digested the information and found a clearer direction. Looking ahead, the upcoming Fed meeting is considered a decisive event. It is not merely an interest rate adjustment, but also a platform where the Fed will provide policy guidance for an entire period ahead. The outcome of this meeting could completely shape the next major trend in the gold market. Therefore, in the days leading up to the meeting, caution must be the top priority. Market sharks may create false volatility to trap retail investors. My advice is to trade carefully, reduce position sizes, and avoid trying to guess the outcome. Safety comes first. Now, let us assume the most positive scenario occurs. The Fed decides to keep interest rates unchanged. This would be a very strong boost, opening the door for gold to continue breaking higher and challenge new peaks. At that point, investors need to closely observe the technical charts. If gold prices can decisively break through key resistance levels, this would be a confirmation signal of a sustainable uptrend. In this scenario, adding to positions to increase exposure would be a reasonable strategy. However, always remember to place stop-loss orders to manage risk. Finally, the Fed's interest rate stabilization stance not only directly impacts gold but also affects the US dollar. When the Fed does not raise interest rates, the attractiveness of the USD decreases relative to other currencies. According to conventional rules, gold and the USD often have an inverse relationship. When the USD weakens, gold priced in USD becomes cheaper for investors holding other currencies, thereby stimulating buying demand and pushing gold prices higher. Therefore, in the short term, even if the Fed simply maintains its current stance, gold may still react positively. Let us turn to the hottest factor at the moment, trade tensions between the United States and the European Union. As we have seen, whenever the two sides take tougher stances, gold prices tend to rise. This is not surprising, because gold has always been regarded as a safe haven asset. My advice at this time is to consider gold as a hedging instrument, a protective barrier for your investment portfolio, especially when political risks show signs of escalating. If you feel uneasy about the stock market or other risky assets, allocating a portion of your capital to gold is a wise strategy. However, the market always has two sides. What goes up quickly can also come down quickly. When trade negotiations show positive signals, when handshakes replace criticism, selling pressure from profit-taking will emerge in the gold market. Gold prices may then experience a corrective pullback. Therefore, the second piece of advice is to always be ready to take partial profits. Do not be overly greedy and wait for the absolute peak. If you notice a downward trend beginning to form, such as lower highs compared to previous peaks, be decisive in locking in your profits. This helps you preserve both capital and gains, instead of watching them evaporate during a correction. One characteristic of markets influenced by political news is sudden volatility. A single tweet or a statement from a high-ranking official can create large price gaps within a trading day. Prices can surge upward or plunge downward within just a few minutes. To cope with this risk, the third and most important piece of advice is to always use stop-loss orders appropriately. A stop-loss is like a safety brake for your trading account. Determine in advance the maximum loss you can accept for each trade and place the stop-loss order as soon as you enter the position. This will help you avoid major shocks and uncontrollable losses. Next, we should note that geopolitical volatility does not only push gold prices in one direction, but can also cause much stronger fluctuations than usual. The market may swing violently within a wide range. The fourth piece of advice is to avoid placing buy or sell orders too close to highly volatile zones or key resistance and support levels created by recent news. Trying to catch a falling knife or chase a train that has already accelerated often carries high risk. Be patient and wait for the market to stabilize or for price to confirm a clearer trend before entering. Patience is the key during periods like this. Although we often focus on the Federal Reserve, do not forget that there are many other major international events that can influence gold prices. A conflict in another region, an important election, or an unexpected economic agreement can all strongly affect market sentiment. My fifth piece of advice is to continuously update yourself with financial news from multiple reputable sources. Maintain a high-quality news feed. Access to fast and accurate information gives you a significant advantage, allowing you to react promptly to market changes instead of passively following the crowd. Finally, the most important thing to remember is that the market always contains unexpected elements. Unforeseen information can emerge and completely change investor sentiment in the blink of an eye. Therefore, the final advice for today is to always keep risk exposure at a low level, especially when rumors or unverified information are circulating. Do not go all in on a single trade based solely on vague news. Manage your capital carefully, divide your position sizes, and never risk too much on one trade. That is how you survive and grow sustainably in this market. In summary, January 22, 2026 is a day that requires caution and flexibility. Closely monitor US-EU trade tensions, use risk management tools such as stop-loss orders, remain patient amid strong volatility, and always stay updated with the latest news. Let's take a look at the bigger picture. The gold market is currently in a very strong uptrend. When such a strong uptrend is in place, every pullback can become an excellent opportunity to enter a trade. My advice is to consider buying when price touches strong support zones. These are the areas where buying pressure usually returns to defend the trend. However, we must not be complacent. If the price unexpectedly breaks below a short-term support low, that could be a warning signal. In this case, considering partial profit-taking is a wise move to preserve gains. Most importantly, stop-loss orders should be placed safely below key support levels to avoid unexpected stop hunts. The current market is experiencing very high volatility. In such an environment, risk management should be the top priority. The most practical advice is to reduce the size of each trade. Trading with smaller position sizes helps balance risk, maintain emotional stability, and survive long-term in the market. Let's keep a close eye on a very important milestone, the $4,800 per ounce level. If gold can break and close firmly above this level, the probability of further upside continuation will be very high. This would be the time to start setting longer-term profit targets. The World Gold Council (WGC) has also stated that short-term corrections will not change gold's strong primary uptrend. Therefore, if you are holding long positions and the main trend remains intact, be patient. The advice is to continue holding buy positions as long as the dominant trend remains bullish. However, there is one factor that could impact gold, and that is the strength of the US dollar. If upcoming US economic data comes out stronger than expected, the US dollar could recover. When the dollar strengthens, gold prices usually face downward pressure. In this scenario, you should consider risk hedging measures to protect your portfolio. Speaking of economic data, We must be extremely cautious when key reports such as PCE and CPI are about to be released. These are moments when the market can become highly volatile and unpredictable. A golden rule is to avoid opening large positions right before major news releases. Waiting for the market to stabilize after the news is much safer. For day traders, your strategy should prioritize risk management over trying to catch exact tops and bottoms. This is nearly impossible to do consistently. Instead, place tight intraday stop-loss orders to limit potential losses. Looking at the domestic market, we are witnessing a remarkable phenomenon. SJC gold prices have surpassed 170 million VND per tael. This reflects very strong demand and sentiment in the Vietnamese market. However, domestic investors should pay close attention to bid-ask spreads and transaction fees. These factors can significantly impact your overall profitability. One important thing to remember is that the domestic market cannot be separated from the global market. Any correction in international gold prices can immediately affect domestic prices, even within the same day. Therefore, if you are holding physical gold, continuously monitoring global prices is essential. Now, let's dive deeper into technical analysis and market psychology. The current trend shows that gold's momentum is very strong. But instead of chasing price, the advice is to patiently wait for breakout signals. A true breakout must be confirmed by strong trading volume. When price breaks above historical highs, investor sentiment often becomes extremely bullish. This is when fear of missing out FOMO reaches its peak. My advice is, never FOMO buy at the top. Wait for a healthy correction or consolidation to find a safer entry point. The current imbalance between supply and demand is making gold more sensitive than ever to global news. You can monitor trading volume to assess the strength of the trend. Rising volume during an uptrend is a very positive signal. One positive sign is that gold support levels are being raised progressively. This indicates stable and persistent buying interest in the market. This is why buying on pullbacks to strong support zones remains an effective strategy. Market volatility has recently expanded beyond normal levels. This is a sign that the market is searching for a new trend. During such periods, once again, I must emphasize, reduce your trading size. Do not forget that gold prices do not move in isolation. They are heavily influenced by the US dollar index DXY and the US 10-year Treasury yield. Always monitor these two indicators alongside the gold price chart. If the dollar strengthens again, gold may experience a deeper correction. In that case, cutting losses when key support levels are broken is mandatory. When the market rallies strongly based on news from the Fed, it often signals that the breakout is real rather than a trap. However, always confirm the move with trading volume. Global risk-off sentiment is currently driving demand for gold as a safe haven asset. If this sentiment continues to intensify, gold could retest new highs. Investors still view gold as an effective hedge amid uncertainty. Nevertheless, you must be ready to adjust your strategy if risk-on sentiment returns. Finally, but no less important, let's talk about risk management and capital strategy. To avoid having your stop-loss hit prematurely by minor intraday fluctuations, you should set stops based on the ATR indicator. Using ATR on shorter timeframes helps define more reasonable stop-loss levels. Instead of waiting to close the entire position at a single target, consider scaling out profits gradually. This strategy is known as laddered profit targets. It helps you lock in profits more safely. And please remember, never go all in on a single asset. Gold should only be one part of a diversified portfolio. Diversification helps reduce overall risk. When major news events are approaching, reducing position exposure is an extremely wise decision. Always reduce risk before the news hits. Another important tip is to trade in alignment with long-term trends rather than focusing solely on short-term news. Long-term trends usually offer greater stability and higher probability of success. Always focus on the bigger picture. You also need to stay flexible and ready to adapt. If the Fed makes any unexpected changes to its forward guidance, you must adjust your positions immediately. Do not let intraday market noise affect your emotions. Establish a disciplined trading plan and strictly follow it. Multi-timeframe analysis, such as reviewing both the 4-hour and daily charts, can help you identify trends more clearly. Always monitor short-term support and resistance levels. These are critical areas for optimizing trade entries and exits. Using these technical levels will significantly improve trading performance. Finally, always stay updated with the economic calendar. News related to the Fed, CPI, and PCE has a direct and strong impact on gold prices. Mastering the economic calendar is the key to effective trading. That concludes all of our analysis, insights, and advice for today's gold market. This content is for reference only, and you should conduct your own research before making any decisions. Remember that no one else will be responsible for your trading decisions. We hope this information helps you in your investment and trading journey. Thank you for watching. Don't forget to like, share the video, and subscribe to the channel so you don't miss the latest updates. Goodbye, and see you next time.